Starting from this section, we will walk through our fee calculation models. In this video, we will focus on the management fee calculations. So these are the key concepts of the management fees. As we mentioned earlier, management fees is normally the 2% of the 2 and the 20 fee structures. However, 2%, despite its industrial standard, in real life operations, there's still a range. Some funds could have lower management fees if they have other terms for performance fees, and some funds could even be higher. So there's a range anywhere between 1.5% to 2.5%. But I have heard for some new funds, they would make no management fee instead of a higher performance fee. So this really depends. Management fees are essential for covering operating expenses within a fund. These fees ensure that the necessary resources are available to manage investment effectively. There are three primary methods for calculating management fees. Commit capital. The fees are based on the total capital committed by investors. Invested capital. Fees are calculated on the actual capital invested in asset, or AUM. Net asset value. Fees are determined by the current value of the fund's asset. In terms of the fee structures, management fees can be structured in two main ways. Fixed rate. Simple and predictable, these fees remain constant. And tier-based structures. These tier-based structures offer potentially lower fees for larger investment, incentivizing more significant commitment. Management fee calculation could be very straightforward if it is a fixed rate. On the right-hand side, there are typical calculations based on a fixed rate. For example, committed capital. It's very straightforward. It's just $100 million times 2%. Then annual fee would be $2 million. However, in a normal fund life cycle, if it is based on fixed commitment capital, it may switch to different type of management fee in later years. So this is a typical fund life cycle image. In the beginning of the investment, the fund has low invested capital, then later has more and more investment. As the fund matures, the investment gets smaller. So if a fund management fee is based on a committed capital, it would have big enough during this time period. However, by the end of this period, when there's not many investment under management, it's just not fair for the investors to still pay that much management fee based on the big commitment in the beginning. That's why if it is fixed rate on commitment capital, in later years, it's very normal to switch to invested capital or NAV. But if it is a fixed rate on invested capital or NAV, it will use the same rate along the fund life cycle. The tier-based is the same concept. It's just the calculation is a little bit different. Tier-based management fee calculations actually works like income tax bracket. For example, in this template, we have 5 tiers, and we have the first tier starting from 0 to $1 million. The next one is annual, a little bit above $1 million to $5 million. And then the rest, we just set the bracket here. And this is the annual management fee for each tier. And this is the template we set up. And this is our calculation table. So for example, if we set up this $1 million, it will only show up this one as a quarterly management fee, 6,250. So if we change this to be the second tier, for example, we make the rate, the management fee, we make it invested capital like $4 million, then the first $1 million of this invested capital will charge 63 basis point quarterly. And then the second tier $3 million will charge the 55 basis point quarterly. So this is just the formula. Whenever there is amount showed up here, it will divide the respective quarter rates into four. So we can keep going. And for example, we will make like a $7 million, then we will have the third tier show up. And then if we make it 9 million, we'll have the oh, it's too big. We'll have make it 9 million, then we'll have this fourth tier show up. And then if we have, for example, make it extremely bigger, then we'll have five tiers filled up here. And then each tier will show you how much it is charged. So this is the formula. It's just based on the rate. And then the note will automatically change based on the amount of money in this tier. And then you can tell this bracket is just like the income tax bracket we have. So for the first $1 million, we would have the management fee about $6,000 here. And then this is the second tier, is the $4 million above this $1 million. And then this is the tiered calculation amount here. And this is our final management fee amount. It's just for comparison. Then you can tell each tier has different rate. So in this case, we can calculate the annualized effective rate should be 1.57%. So it's just to simply use the management fee amount divided by the total invested capital and then times 4 quarters. So this comes to our question. Which fee structure should you use? So we can tell the tier-based management fee structure has its own advantages. It's good for larger funds. They can negotiate lower fees for their excess capital, right? And then if the fund has multiple closing period, a tier-based fee could decrease the fee rate and incentivizing larger commitment for sure. And also, it could benefit from the economics of scale, and this is a favorable fee structure for many of the big investors. So by the end, the fund manager will need to determine should they use simple and predictable fixed rate structure, or they should use the potentially lower fees for large investment tier-based structure.